Ind AS 102 Share-based payments. Share-based payments is an agreement between the reporting entity and another party, including an employee, in which the entity is to receive goods or services against payment of shares of a reporting entity, that is equity settled, or cash, that is based on price of the equity shares of the reporting entity, that is cash settled. So share-based payments may be equity settled or cash settled. Ind AS 102 is not applicable to issue of shares to shareholders in their capacity as shareholders, example bonus shares, right shares, and equity shares issued in business combination to acquire control. There is certain exception. Exception is if equity shares are issued to acquire his employee in their capacity as employee, then covered under Ind AS 102. Next, financial instruments issued to buy or sell non-financial item which can be settled on net basis. If intention is to settle on net basis, apply Ind AS 109. If intention is to take delivery, then apply Ind AS 102. So we need to check the intentions. If intention is to deliver, to take the delivery, then Ind AS 102 is applicable. Otherwise, Ind AS 102 is not applicable. Share-based payments with other than employee or non-employee. Journal entries in case of equity settled. Expense or asset account debit to SBP reserve account, SBP reserve account debit to equity share capital to securities premium. In case of a cash settled, the entries will be expense or asset account debit to SBP liability, SBP liability account debit to cash or bank. Measurement: while measuring SBP, first preference will be given to fair value of goods or services acquired. Second preference will be given to fair value of shares given. Next, guidance on booking of expenses in case of services received from non-employee. In case of one-time service, book full expenditure immediately. In case of continuous service, example of continuous service is maintenance service for 3 months. Book expenditure proportionately in every month. Next, share-based payments with employees, that is equity settled. In equity settled, first there will be grant date. Grant date means a date on which entity and another party, including employee, agree to a share-based payment agreement. That is date of such agreement. If agreement is subject to approval of appropriate authorities, then grant date will be date of approval. Conditions. There are two types of conditions: vesting condition, non-vesting condition. Vesting condition are again divided into two categories: service condition, performance condition. Service condition, that means condition to serve for a specified period. Example, employees have to remain in service for 3 years. This is a service condition. This service condition is within the control of the employee. It will be considered in vesting period. Next, performance condition. Performance condition is again divided into two categories: non-market based, market based. In case of non-market based performance condition, it is a condition to achieve performance targets. Example, sales target, profit target, cost reduction target, etc. It is within the control of the employee. It is considered in vesting period. Next, market based condition. It is the condition to achieve specified target price or value of shares. It is not within the control of the employee. It is not considered in vesting period. Next, non-vesting conditions. That means conditions that does not have any impact on eligibility of share-based payments. Example, shares with 3-year lock-in period. It is a non-vesting condition. It is not considered in vesting period. Next, recognition and allocation of expense. Share-based payment granted to employees are expense for the company, which are to be recognized during the vesting period proportionately. Vesting period means a period during which all specified vesting conditions are to be satisfied. How to calculate the expense to be recognized each year? Expense to be recognized each year equals to number of employees expected to fulfill the conditions at a year end into number of options into fair value of options on grant date into expired period divided by total vesting period. Whole minus expenses already recognized in previous years. Fair value on grant date is taken in case of equity settled transactions. Fair value changes post grant date are not considered in case of equity settled transactions. So in case of equity settled transactions, only fair value on grant date will be considered. The journal entries will be on grant date, there will be no entry. At the end of each year during vesting period, first booking of expenses entry. Employee benefit expense account debit to SVP reserve account. Employee benefit expense will be transferred to P&L. SVP reserve will be shown under the head other equity. Expense will be booked proportionately each year during the vesting period, calculated as per above formula. Next, reversal of expense, if any, during the vesting period. If during the vesting period, if any reversal is done regarding the expenditure, the entry will be SBP reserve account debit to employee benefit expense account. SBP reserve will be shown under other equity. Employee benefit expense will be transferred to P&L account. During excess period, on excess of options by employees, entry will be SBP reserve account debit to equity share capital to securities premium account, if any. If any options lapse during excess period, entry will be SBP reserve account debit to retained earnings. Both are shown under other equity. Both SBP reserve and retained earnings will be shown under other equity. Next, in case of equity settled transactions, reversal of expense through P&L can be done only during the vesting period. Post vesting period, there will be no reversal of expense can be done through P&L. Only transfer within the equity can be done. That is, transfer SVP reserve to retained earnings. It is permitted. Market-based conditions. Any change in market condition will have no effect on estimation of expense. We will continue to record expense even if market conditions have failed. That is, expense cannot be reversed due to failure of market conditions. If market conditions are satisfied earlier than expected, prospective expense of future years should be recognized in the year of vesting. That is, accelerated expense should be recognized. If market conditions delay vesting period, a recognition of expense should not be delayed. That is, expense should be recorded. Expense should be recorded as planned. At the end, if market conditions never fulfilled, then the balance in SBP reserve will be transferred to retained earnings. That is, transfer within equity and not through P&L. Modifications. Modification means increase in number of options or increase in fair value of options. In case of increase in number of options, there are two steps. Step number one, calculate additional advantages, that is extra options granted into fair value on modification date. Step number two, amortize over the period from modification date till the date of vesting of modified options. Next, in case of increase in fair value of options, there are two steps. Step number one, step number two. Step number one, calculate additional advantage, that is fair value after modification less fair value before modification on modification date into original number of options. Step number two, amortize over the period from the modification date till the date of vesting of modified options. In case of modification, account for original SBP separately and modification separately. Next, cancellation other than by forfeiture due to vesting conditions not satisfied. Cancellation are done midway during the vesting period. Expense for future years is yet to be recognized. In case of cancellation, there are two options: cancellation without compensation, cancellation with compensation. In case of cancellation without compensation, there will be three steps. Step number one, expense for the year should be recorded as it is. Step number two, future year expense not yet recognized should also be recognized in the year of cancellation. Step number three, full balance of SBP reserve should be transferred to retained earnings. The journal entry will be SBP reserve account debit to retained earnings. Next, cancellation with compensation, 3 points will be the same. That means the first step, expense for the year should be recorded as it is. Second, future year expense not yet recognized should also be recognized in the year of cancellation. Third, full balance of SBP reserve should be transferred to retained earnings. Next, pay compensation. The journal entry will be retained earnings account debit, P&L account debit to cashier bank account. Cashier bank account amount paid. Retained earnings amount should be debited. What amount should be debited? Maximum amount that can be debited to retained earnings is options cancelled into fair value as on date of cancellation. Profit and loss account balance will be balancing figure. To cashier bank will be amount paid. Next, cash settled Share-based payment for employees, also known as stock appreciation rights, SAR. Similar to equity settled, except fair value should be remeasured through P&L, that is employee benefit expense, at the end of each reporting period, during the vesting period and post vesting period, till the options are exercised using the fair value on each year end. Calculation of expense to be recognized each year. Number of employees expected to fulfill the conditions at the year end into number of options into fair value of options at the end of reporting period into expired period divided by total vesting period. Whole minus expense already recognized in previous years. That will be the expense to be recognized each year. The journal entries will be on grant date, there will be no entry. At the end of each year during vesting period, booking of expense. The entry will be employee benefit expense account debit to SBP liability. Employee benefit expense will be charged to P&L account. Reversal of expense during vesting period. The entry will be SBP liability account debit to employee benefit expense account. During excess period, booking of fair value changes, if any, during excess period. If fair value increases, the entry will be employee benefit expense account debit to SBP liability account. If fair value decreases, the entry will be SBP liability account debit to employee benefit expense. On payment of cash, the entry will be SBP liability account debit to cash or bank. Stock appreciation rights that vest immediately. That means SARs that vest immediately. In some cases, SARs issued vest immediately. That is, on grant date itself, as no vesting conditions are there. In such cases, employees are given excess period to exercise the option, which can be more than 1 year. In such cases, fair value of SARs need to be remeasured at the end of each reporting period till the options are exercised. The journal entries will be on grant date, employee benefit expense account debit to SBP liability account. Book full expense based on fair value on grant date as shares vest immediately. During the excess period, booking of fair value changes at each year and during excess period till the options are exercised. If fair value increases, employee benefit expense account debit to SBP liability account. If fair value decreases, SBP liability account debit to employee benefit expense account. On payment of cash, SBP liability account debit to cash or bank account. In cash settled, if any change occurs in fair value during the excess period, then share-based payment liability is remeasured through P&L, that is SBP, employee benefit expense account. But in case of equity settled, we never remeasure during the excess period. Share-based payment with cash alternative. In case of share-based payments with cash alternative, there will be two options. Option number one, choice is with counterparty. Option number two, choice is with the entity. First one, choice is with counterparty, that is employees. In such a case, treat it as compound financial instrument. In that case, there are 5 steps. Step number 1, identify value of ESOP on grant date based on equity based settlement, that equals to number of shares or options to be allotted into fair value of equity settled option on grant date. Step number 2, identify value of cash settled option, that is debt component, number of options in SAR into fair value of cash settled SAR on grant date. Step number 3, value of equity component. Equity settled ESOP as per step number 1 less cash settled ESOP as per step number 2, we will get value of equity component. If the value of equity settled ESOP is less than or equals to cash settled ESOP, then value of equity component is 0. Step number 4, equity component as per step number 3 is recognized in SBP reserve proportionately during the vesting period. Step number 5, cash settled, that is debt component, is recognized in SBP liability during the vesting period, which requires remeasurement each year. That is, expenses booked based on fair value at the end of each year. The journal entries will be as follows. On grant date, there will be no entry. Only computations are done for step number 1, step number 2, step number 3. At the end of each year during vesting period, booking expense of equity component and liability component. Employee benefit expense account debit to SBP reserve account as per step number 4. Employee benefit expense account debit to SBP liability account as per step number 5, or employee benefit expense account debit to SBP reserve to SBP liability. Upon settlement, that is upon excess, If counterparty, employees chooses cash option, on payment of cash, the entry will be SBP liability account debit to cash or bank. On transfer of SBP reserve balance to retained earnings, that is transfer within other equity, SBP reserve account debit to retained earnings. If counterparty, that is employee, chooses equity settled option, that is transfer of SBP liability to SBP reserve, entry will be SBP liability account debit to SBP reserve account. In case of issue of shares, entry will be SBP reserve account debit to equity share capital to securities premium, if any. Transfer balance in SBP reserve, if any, to retained earnings. That is transfer within other equity. SBP reserve account debit to retained earnings. In case of other option, option number 2, if choice is with the entity, equity settle accounting treatment will be required when there is no obligation to settle in cash. Treat as cash settle only when it has present obligation to settle in cash. Present obligation can be identified in following situations. Entity cannot issue shares due to some restrictions. Stated policy to settle in cash. Past practice or history to settle such type of transactions in cash. If equity settle, accounting has been done, but the settlement is required to be done in cash, then the entry will be SBP reserve account debit to bank account. If balance in SBP reserve is not sufficient, then balance will be debited to P&L account. Example, SBP reserve 1 lakh per equity settled. Settlement required in cash 1 lakh 20. The entry will be SBP reserve account debit 1 lakh, P&L account debit 20,000 to bank account 1 lakh 20,000. Group share based payments plans. When parent issues its own shares to employees of subsidiary for share based payment of subsidiary, in the books of the parent, entry will be in the books of parent, investment in subsidiary account debit to SBP reserve account, SBP reserve account debit to equity share capital. In the books of subsidiary, employee benefit expense account debit to capital contribution from parent account.